Assalamualaikum and hi everyone. I am Madam Liza. Welcome to my channel. If you are returning, welcome back. In today's session, we are going to discuss a question relating to MFRS 140. This is question July 2023 and this is question 2. So let's start. And let's read the question first. But before that, this is question 2A. You have a company, Queen in Berhad, that owns a 4-story building in Teluk Bahang. So 4-story building, it is a multi-story, where you are informed here each floor can be sold or rented out individually. During the year ended 31st December 2022, the company provides the following information regarding the 4-story building. So each of the floor has different usage. So let's start with the first one. And before that, let us look at what is the requirement of this question. You are asked to state whether each of the floors can be classified as investment property or not. So you have to state just investment property or not investment property. You do not need to explain why it is investment property or why it is not investment property. But somehow I will explain for the purpose of enhancing your understanding. So we start with the first one. The first one is floor 1 here. You are informed that for floor 1, it has been leased out to Plum, which is the lessee under operating lease. So if it is leased out under operating lease, paragraph 8 of MFRS 140 has indicated that that was an example of IP. Even if Plum has converted it into hotel, we are looking at the point of view of Queen Inn as the owner. Second one, floor number 2. So for floor number 2, you have the information here says that it is being rented out for employees. Under MFRS 140, floors that is rented out to employees, this is regarded as owner-occupied property. So if it's an owner-occupied property, this is not an IP. So this is not an IP. So you just have to answer that. Next, we go to the number 3. Number 3, floor number 3. Remember, it has 4-story here. Queen Inn uses the floor to operate a hotel chain branded as Bunga Hotel. So it's Queen Inn itself that operate a hotel. So under MFRS 140, hotel is an example of not an IP because they provide significant services to the customer or to the client, and therefore hotel chain is not an IP. That will be classified as owner occupied property, and this is not an IP. So it will be classified under MFRS 116 for floor number 2 and floor number 3. Floor number 1 is an item under MFRS 140. Let's move on to the last one, floor 4. Floor 4, which is currently unoccupied. So this is indicating that the floor is vacant. So when the floor is vacant, you need to go and see whether there is further information. So you're informed that the company is not sure yet of how to utilize it. So when you are not sure, this is considered as an undetermined under MFRS 140. This is considered as undetermined future use. So if it's an undetermined future use, it will be classified as investment property. So that is an investment property. So let's move on to part B of the question. Part B of the question is relating to recognition and measurement of investment property, and also the calculation of initial costs. So you have the information of another company, Win Berhad, that acquired, so this is the date of acquisition here, 1st of January 2018, a building. So the building is somehow costs you 12 million in Kobo Island. You are trying to think of whether the building is an IP or not. So you have to go and check and read further to see whether there is an indicator that that was an IP. Before that, if you look at the requirement of the question, you are asked to prepare the journal entries in the books of Win for the 1st of January 2018. So whatever transaction on 1st of January 2018 will be included. So we have the information that the company, apart from having the purchase price here, and recall that initial cost equal purchase price plus directly attributable cost. This is similar to Mfrs 116 PPE, the concept of initial measurement and initial recognition. Upon acquiring the building, the company also faced or incurred legal expenses of 350,000. At the same time, the company also incurred admin costs of 70,000. Legal expenses is an example of directly attributable costs. So another one that you have there is admin expenses. Admin expenses is not included under the calculation of initial costs. So this one will be excluded because it does not meet the criteria for recognition as an IP, and therefore that would be expense of as incurred. Expense of where to this current year statement of profit or loss. You are also further informed here regarding the useful life of the building. So the useful life of the building will be relevant in terms of if you are adopting for cost model, but we have to check further. You are informed that the building was being rented out. So when you have this sentence, rented out to Jamie under operating list, this is similar to the situation above just now, where we have already concluded that if you have items that are lease out, the building lease out under operating list, that is an IP. So similar to the situation here. So therefore the building here that was rented out under operating list for 360,000 rental income per annum, that would be an IP. So the building, you can conclude now it is an IP because it is held for operating list, rented out under operating list. So that was the first part of the set question, where these are all the information relating to your initial recognition and measurement. The second part of the information here is relating to subsequent measurement. So subsequent measurement is somewhere starting from the sentence, the last two sentences. So I'm going to use a different color for subsequent measurement. I use green. And as at 31st of December 2019, which is the following year, the year of acquisition is 2018, 31st of December, the fair value of the building was 11 million, fair value. You are also informed another one, which is as at 31st of December 2022, the fair value is 11.8. So there are changes in the two fair values, and you are also informed that the company adopt fair value model. So under fair value model, if this is for subsequent measurement, you are informed that there will be no depreciation. So you are going to take into consideration the changes in fair value that will happen as at 31st of December 2019 onwards, which is the requirement in number 2 for you to prepare the journal entries to record those changes in fair value for both years, 31st of December 2019 and 31st of December 2022. So let's look at our answer now. So earlier on we have decided on that part, and before that the part A was on classification. Let us look at how much is the initial cost. So initial cost here would be 12 million. Sorry about that. Okay. Initial cost would be 12 million. This 12 million and plus 350,000. At the same time, there was another information that I did not highlight earlier on. It was about the trade discount of 1% given to the purchase price. So your trade discount will have to be deducted against the purchase price. So if you do that, you would see that it would be 12 million plus 350,000 minus 1% from 12 million. So that will give you the total initial cost, and that will have to be journalized, and that will be the item that you will include under the first journal entry, debit investment property, and you will credit bank or you will credit payable. And that is the calculation of initial cost here. Right, I put that IC. So it is going to be 12.23. And do not forget about the admin expenses that you incurred. You cannot add up to the initial cost, but that must be included as expense off in the SOPL. So that will be debited to the admin expenses. And if you pay the admin expenses, you credit the bank, or else that would be an accrued admin costs. Next, we go to the part on fair value changes. So I'm going to draw a timeline here to show you the fair value changes. So here on 1st of January 2018, this is the date of acquisition or the date of purchase. And the cost of the investment property you have already determined just now was 12.23 million. And there is no depreciation to start with because the company used fair value model. So after a year, which is on 31st of December 2018, you are adopting fair value model. So you have to take into consideration the changes of the fair value. The first fair value information is 11 million. And the second fair value information, which is on 31st of December 2022, sorry, so I have to erase this. This is 2022. So that was after 2 years here. And this one is there was another 3 years, 31st of December 2022. Remember, no depreciation. Why? Fair value model. So this is after 3 years. You have another fair value 2, and that was 11.8. So since there is no depreciation, this would be your carrying value 1, or where you will compare there with your fair value. So 12.23. And the difference here, where you can see that fair value is less than carrying value, and this will give you fair value loss. So the difference is not a revaluation deficit. Do not confuse yourself with that. This is under Mfrs 140. Fair value model is not the same as revaluation model. So you will see the difference there, and this will be debited to the profit or loss as fair value loss and credited to investment property. The second fair value exercise, you will compare the fair value before that, and that will become carrying value in the 31st of December 2022. That will be 11 million. And this 0.8 million, you can see that this is where fair value exceed carrying value, and this is what you call fair value gain, or also known as increase in fair value. Fair value loss, also known as decrease in fair value, but both are fair value changes. So this will be credited to the profit or loss that will be disclosed under other income, and will be debited to the investment property. And in the statement of financial position, when you are going to report the carrying value will be at the fair value for 31st December 2022, and as at 31st December 2019 the carrying value will be 11 million shown in the soft P. So this will be in the soft P, but the one here will be in the SOPL, here will be in the SOPL. And what we're going to do now is we're going to look at the journal entry. So let's just put this side by side. So for the first journal entry, you have to write the date. The date means 31st of December 2019. You will debit the fair value loss in the SOPL, because the difference here is 1.23 million. This is the one that you took to the SOPL. And in the second year, it was a gain. So that gain in the second year will be credited, and that will be shown as an income. And that was in 2022. Next, we go to the next part, which is to prepare the journal entries. Yeah, we have done 1 and 2. Now we move on to the next part, which is on transfer of property. So let's look at this part. Part C. Part C here is a transfer, just to let you know, a transfer from owner-occupied property, which is a PPE, owner-occupied property, to IP. So this is the case here. So let's read the question. You have another different company own an office building, and that office building is used for admin purpose, which was bought on 1st of January 2021, and now it has a carrying value. So carrying value was 28 million. So carrying value. Next, this is going to be an owner-occupied property. So this is a PPE on that date. You are informed the remaining useful life of that building at that date is 1st of January 2021. This date here is 20 years. You are also informed the company adopts revaluation model. So for the revaluation model, that was for the case of PPE. So I'm going to put a note here that this is using the revaluation model for the PPE. And you have another information which I will use a different highlighter. You have the one as at 1st of January 2022. The office building was leased out to another company called Bumita. And when it was leased out, it was reclassified as investment property. So when there was a reclassification of building to investment property, building that was first held as owner-occupied property, which is under Mfrs 116 before this, now it is reclassified to become investment property. So meaning that now the MFRS that you have to apply starting from 1st of January 2022 is MFRS 140. And you are informed the fair value model was adopted. Fair value model was adopted on subsequent measurement of its investment property. So for investment property, the situation here is that it is using fair value model. So meaning that there is a transfer from PPE that uses revaluation model to investment property that will adopt a fair value model. You have some information here which relates to investment property. The fair value of the office building. So what's the fair value of the item building? Does not matter whether it is an IP or not, but that is the fair value. 32 million, and that was on the date of transfer. So this is the date of transfer, which I have already highlighted earlier. That was 1st January 2022. It was 32 million. And then you have another one, 33 million. That happens on 31st of December 2022, which is at the end of the current year of transfer. You are asked to advise Buana on the accounting treatment for the change of use. Change of use here is from office building that was an owner occupied, and now office building will no longer be the office building, but it will be turned into an IP, investment building. So that starts on 1st of January 2022. You are asked to advise the accounting treatment, meaning that you need to write what is prescribed under Mfrs 140. That would be for the year ended 31st of December 2022, which means that you need to not only discuss the one at the end of the year, you need to discuss what happened on 31st of December 2022 and 1st of January 2022 as well. So whatever happened throughout this year, the one that I have drawn then. All right. Before we can do that, let us just look at the timeline so that you can have a better picture. So the timeline that I will draw here is to help you give advice. So if you can see here, the date of transfer. Before that, it was the date of date that it was still an owner occupied property, 1st of January 2021. Here it is having a PPE, and this is the carrying value of the PPE is how much was that? 28 million. And the estimated useful life of the PPE is, sorry about that, estimated useful life of the PPE is how many years? 20 years. So remember, it is using revaluation model for the PPE. So of course there will be depreciation on that date. So here revaluation model. I just put here revaluation model. So you will provide depreciation. And then 1st of January 2022 is here. On this date, you have a change. So I put here the signage change. Here there is a change in use. What was the change in use? It was the change from PPE to IP. That was the change in use. And on that date, you are informed the fair value of the building, which is here, was 32 million. Fair value 32 million. Again, you are informed another detail here regarding 31st of December 22, where the fair value of the asset now becomes 33.6 million. Okay, 33.6 million. So what you need under Mfrs 140, if the asset was previously an item of owner-occupied property on the date of transfer. So when is the date of transfer? I put here DOT. So this one is the date of transfer. Let me just highlight that. Okay, this is the date of transfer. Date of transfer. On the date of transfer, you will have to measure the carrying value. Yeah, you have to measure the carrying value. So you have to measure the carrying value. What is the carrying value? Carrying value of the building. So the carrying value of the building will be cost minus accumulated depreciation. So we have no information regarding the revaluation. Maybe it was done before that, so I'll just change that to become to just take the carrying value minus the accumulated depreciation. So the carrying value here would be 28 million, and you need to go and remove the accumulated depreciation for 1 year, which is only 1 year from here up till here. So if you calculate that, your accumulated depreciation would be, I put here AD, it would be here, I'm doing it here, depreciation, it would be 28 million divided by 20 years. So that will give you a depreciation of 1.4 million. So for 1 year, the accumulated depreciation is also 1.4 million. And you will compare this with your fair value. Your fair value that was on the date of transfer. And that is how much? So you have to check how much is that actually. And that would be 26.6. So you need to do this. And the difference between this under fair value, under the MFRS 140, the difference between the fair value on the date of transfer and the carrying value of the PPE on the date of transfer, regardless what is the measurement model used, either it is a revaluation model or cost model. When it was a PPE, the difference will have to be treated as per MFRS 116 revaluation surplus or revaluation deficit. So in our case here, there is a revaluation surplus. So since it was a revaluation model, to confirm, so you have 5.4 million, and this is revaluation surplus. And revaluation surplus, as usual, it will be debited to the PPE and credited to the asset revaluation reserve unless you have previous deficit. So for the second year, and take note that this will be the deemed, okay, on the date of transfer, this is the deemed cost of your IP. The fair value of the office building on the date of transfer will be the deemed cost of IP. And remember, office building at that time was still a PPE. So on the second year, this is just an information regarding the fair value changes. So you will compare this here, carrying value. This is fair value 2, this is fair value 1. So this one will be compared 32 million, and the difference here, you will see that was 1.6 million. You have to check on that, and therefore that would be not a surplus, but this will be treated as fair value gain, because from this onward, this 1st of January 2022 onwards, you are adopting fair value model, and from this date onward, this is an IP, so it is no longer a PPE. So let's explain that. But before that, let me just show a few journal entries on 1st of January 2022. The question does not ask you the journal entry, but this is a bonus answer. On that date, first, you have to debit IP 32 million. Remember, this is the deemed cost of it. And the accumulated depreciation that was for the PPE must be eliminated. So I put there AD, accumulated depreciation. And remember, on that date, you recognize a surplus, right, on the date of transfer, only on the date of transfer here, that you have to treat that as revaluation surplus, regardless the measurement model used. If it's a cost model as well, you will still treat this as revaluation surplus. So 5.4 here, and you will have to go and de-recognize the building that was a PPE, and you now recognize building that is an IP. And how much is that? 28 million here, right? That was the journal entry for 1st of January. For the one on 31st of December 2022, you have to recognize the fair value gain. And that fair value gain is where you debit your IP, credit fair value gain. This is on 31st of December. This is on the date of transfer, DOT, when there is a change in use. This is after a year, so you recognize 1.6 million as a fair value gain. Okay, let us look at the explanation. So you need to know the journal entry as well. So let's look at the explanation here. Okay, I just increase the size, or I just put it side by side. Yeah, I put it side by side. Okay, so let's look at the first part. Number one, you need to mention what happened on that date of transfer. So on the date of transfer, what happened? So on 1st of January, which is the date of transfer, state the date. There is a transfer from PPE to investment property. Why there is a transfer? Give the reason. The reason is because there is a change in use. Change in use means change from the use of owner-occupied property to become being rented out, and that is a PPE. So it is from owner-occupied, held to be rented out. Then mention about the carrying value on the date of transfer. What is the carrying value on the date of transfer? So the carrying value on the date of transfer was 26.6 million. That's why we need to do the calculation earlier here, where we have already calculated this one here, right? 26.6, which is cost minus accumulated depreciation. That was the carrying value of the PPE. And that difference between the carrying value of the PPE and the fair value on the transfer date is a revaluation surplus. So we are explaining our calculation here. Yeah, our calculation here. This one, 5.4. And just now was 26.6. Next, the difference between the carrying value is treated as that, and mention what is the accounting treatment. So it is credited to the asset revaluation reserve. So now you have already closed the PPE account, and now it is going to be under MFRS 140. So under MFRS 140, okay, under MFRS 140, you need to go and explain what is the treatment. So let me just highlight that. Okay. Okay. Under MFRS 140, on the date of transfer, the deemed cost, so which is the deemed cost of IP, will be measured at its fair value. So at its fair value, how much is it? It is 32 million. 32 million here is the one on the date of transfer. You have to mention what is the deemed cost of IP. So therefore, you have to write down the 32 million there. Next is to explain what happened at the end of the year. At the end of the year is where fair value is greater than the carrying value, so that figure 1.6 million here, 1.6 million will have to be credited to the statement of profit or loss. Why? Since the company adopts fair value model. So if the company adopts fair value model, the difference will be treated to the fair value gain in the statement of profit or loss. And you need to put extra sentence here. There is no depreciation charge. Why? Because the company adopts fair value model. So that's it for the answer for this question. And remember, I told you, regardless the measurement model used under the when it is a transfer, the on the day of transfer, the carrying value of the PPE the changes will be reflected as revaluation, surplus, or deficit. Thank you for watching. I'll see you when I'll see you. Assalamualaikum and have a pleasant day ahead.